want me to introduce myself today. That's how much you want me to just stand here and dish out analysis after Tuesday's obliteration in software stocks. Well, I'm doing the intro anyway because it's my show. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid, coming to you live from Yahoo Finance's headquarters in New York City. Now, about those software stocks in this overall tech stock moment. Far be it for me to offer up a differing perspective in the almighty AI chip god, more formally known as NVIDIA founder and CEO Jensen Huang. But this one time, as it pertains to the AI stock rout we are witnessing, I must, as they say, push back on the often leather jacket-clad Big J. Here's what Jensen said at the Cisco's AI Summit on Tuesday. While all these software names were absolutely getting shredded to pieces. Here's what he said.
Software is a tool. There's this notion that the tool in the software industry is in decline and will be replaced by AI. You could tell because there's a whole bunch of software companies whose stock prices are under a lot of pressure because somehow AI is going to replace them. It is the most illogical thing in the world, and time will prove itself.
If I had Jensen's bank account too, I'd be cool, calm, and collected on a white couch. At this crucial moment for tech investors, though, the market could care less what Jensen has to say on this topic. Sure, Jensen is often the one that stirs the drink in markets, in part because NVIDIA is the one that stirs the drink in markets. But the market fully believes software companies such as Salesforce, Workday, Thomson Reuters, SAP, and ServiceNow have their terminal values at risk because of quick developing advancements in AI. What, you think Anthropic and the brother and sister leadership combo of Dario and Daniela Amodei won't lean in more into these AI tools to try and render software companies obsolete? Their only goal is to drive value higher for Anthropic investors. They could care less about the feelings of Mark Benioff over at Salesforce, who's seen his stock plunge 42% in the past year because of these AI fears. So this is a very important tech moment, and I have the right panel here on the Opening Bid Roundtable. Tom Sosnoff, Lost Dog founder and CEO, alongside Yahoo Finance senior reporter Brooke DePalma. Good morning to you both. Tom, coming to you after a big sell-off yesterday on fears like this. Where is your head?
Well, listen, I run a software company, so I'm all in on software. That's where my head's at. But from a trader side, I mean, I kind of like it. Isn't this an opportunity? Isn't this what we all kind of dream about as investors or as traders? You know, you want high volatility, lower prices, lower basis, and it gives you more upside, doesn't it?
Tom, you're the man. All right, so you have been in the software business for a long time. Let's go there. You are operating a software company. How are you trying to compete with AI companies?
Well, this is my third software company. We built two financial brokerage firms, and I've been in fintech now for almost 40 years. I just roll with it. So what we're doing now with this latest software company is we've just embedded a lot of AI into our technology. So it's kind of like, I really don't get it. I kind of agree with Jensen in a way that I don't understand where the pressure is coming from, other than a lot of these stocks were too hyped and too overpriced. But it's pretty easy as a software company to embed a lot of the new AI tools and functionality and all the features, and it's relatively cheap to do, and it's relatively easy, and it doesn't have a long lead time. So I just think that full integration, that's how we're addressing it.
Quick plug to the new Yahoo Scout. Love me some Yahoo Scout, Brooke. I use this thing around the clock now. Use it on Yahoo Finance. Stuff is awesome. But Brooke, I mentioned at the top of the show, these sell-offs have gotten pretty serious too. Really, and it's not just the likes of legal names. I mean, it's really started to spread yesterday, more so to a Salesforce, a ServiceNow, or ServiceNow, these companies that already have been pounded year to date.
Yes, certainly. As you showed earlier within the show, all these software stocks largely in the red to kick off today's trading session. And also earlier this week, Piper Sandler downgraded a few stocks there, Adobe, Freshworks, Vertex, and that really sort of gained momentum as we're making our way into this middle of the week. And on top of that, too, a lot of this rhetoric that we're hearing from the street is kind of like, I told you so. JP Morgan out with a note this morning saying that over the past 3 years, they've been warning their clients that that this could happen, that the AI is essentially coming for software here. They essentially said within the note that it's changing fast, that it could seriously change the landscape of software companies, and that these companies even need to evolve even more so than what they already have been trying to do. And on top of that too, they even said that they ran multiple quote unquote death of software webinars to get investors ahead of this. And so was there a bubble within the software? Like Tom said, were these valuations a little too hot for the street to handle? And now are we seeing a pullback as investors try to digest and understand where these software stocks stand as we move forward in a world where AI has just become more and more prominent towards the end of 2025 and really ramping up and serious implications moving into 2026?
Tom, back to you. Look, these companies, software companies that got hit double digits yesterday, they're not going out of business today or tomorrow. But what is your buy signal on a company, let's say for Thomson Reuters? I mean, they're so dominant in their field, and I'm just not to single them out, but companies like that, what do you need to see as a trader?
Well, there's a couple things. So as a trader, you want to see and again, not everybody follows volatility, but what you really want to see is some capitulation. And nobody knows, really nobody knows price. In other words, so it's very subjective. So when stocks get too cheap, it's completely subjective whether or not that's a bottom or whatever. But when you can see a lot of selling pressure, which comes in the form of really high volatility, which just is expected move. So when you get really high volatility and you see a lot of selling pressure, which you can see in volume, then you start to get to the point where you're like, okay, this looks like it's some form of capitulation. And as a trader and or investor, it doesn't matter. That's where you want to jump in. I mean, the challenge right now is that you've got a generation of traders and investors that have never seen a down move. And I'm a grizzly old trader that's been around.
Come on, Tom. You're still a young guy.
I mean, I traded in the '87 crash, so I'm very familiar with little sell-off. So I'm okay with this. But I think there's a lot of people out there, Brian, that have never even seen a down move, and they're looking at this like, oh man, look at this, 20%. Who cares? It's just an opportunity.
Was yesterday, Tom? Was that a mini crash?
No, that was not a mini crash. I would say if you want to say the closest thing to a mini crash, probably would have been silver and gold last Friday. Mm-hmm. That was the closest thing you get to like a kind of a mini crash type thing. But no, that was not a mini crash. But yesterday was really interesting because there's a lot of stocks that, especially in the fintech space, but the key is you need liquidity. Don't get involved in stuff that doesn't have liquidity. If it has liquidity, sure, you can nibble anywhere.
You know what's interesting, Tom? I think people just see the declines on the screen. They're like, oh, the stock is down. But at the core, those are humans or machines selling their stock. Where is all that money going? Do you see it going into cash? Is it other sectors of the market? It is not necessarily went back into gold and silver after those moves stopped a couple days ago. Well,
I mean, I can tell you from what we're seeing on the retail side, some of it's going into, listen, because I trade like a contrarian and I invest like a contrarian. For me, the last couple of days, we've been buying digital assets. We've been getting long some debt, like some bonds. I think they're cheap. Bonds and notes are cheap relative to the rest of the market. Digital assets are definitely cheap. And I've also been buying some fintech stocks. Like there are stocks out there, like example for Robinhood and things like that are very liquid, that have gotten really cheap. And there's plenty of stocks now that have lost, in some cases, even stocks I don't even like to buy, like Oracle, they're down, 60% off their highs. It's like some crazy kind of numbers out there that are finally getting interesting.
Brooke, what I found so interesting about the action yesterday, and I'm still watching this today, it's Walmart. So while we're seeing these software stocks get absolutely smashed to pieces, you have Walmart crossing that $1 trillion market cap level. I don't know if investors realize, I mean, Walmart's a tech play at this point, and they sure have a lot of software internally at that company.
And Brian, I think that them relisting to the NASDAQ, where I am right now, really signifies that they intend to compete with Amazon, that they do want to be looked at as a tech player moving forward, and also a pretty significant move that they really are the first retailer to cross that $1 trillion threshold. Trillion dollar club, we think of NVIDIA and Microsoft and Amazon, not necessarily Walmart, but now think about the market cap and the momentum that they've gotten, especially within their valuation really over the past few years, as not only only have they made major advancements in automation, now most recently AI and technology when it comes to delivery and convenience, but on top of that, they've been doing really well when it comes to just what their old play was, seeing out what the consumer wants right now, low prices and convenience, and that's gained the attention of high-income shoppers, and it continues to as we make way into this year.
Brooke, let's stay on the consumer because I went off the rails about 2 minutes after those Chipotle results hit. Put out a post on X, 3 reasons why it was just a terrible quarter. And I didn't leave that earnings call from Chipotle last night feeling too confident. I'm going to continue to beat this drum. They need a $1 menu. They can keep their menu super expensive as it is now. Just carve me out a portion where I can get a taco for $1. And that's all I need. And I think that'd be a stock catalyst.
I mean, Brian, don't get too excited just yet because it's typical to what Chipotle normally says. They plan to increase prices about 1% to 2%. That's like the typical cadence. And also, Scott Boatwright, the CEO at Chipotle, did tell investors on the call that they have this consumer where 60% of their core consumer makes over $100,000. They also said that that consumer is really seeking out high protein. And also, if they feel like the value's worth it, they're willing to splurge. And so in that sort of case, it seems like they were trying to make the case that not only do they have the ability to raise prices, but now they're looking for more ways to cater this consumer who's willing to pay up for clean ingredients and high protein.
All right, speaking of affordability, here's what PepsiCo CEO Ramon Laguarta told me yesterday about all that.
The middle, lower income consumer, quite stable, same as last quarter, but still very stretched in their budgets, trying to be choiceful and cautious on how they spend their money, especially discretionary categories. When we talk to consumers, they're telling us, we would buy more of your products only if they were more affordable.
Tom, any interest in trading some of these consumer names that have pulled back, namely a Chipotle, on affordability concerns? There are catalysts coming up in the spring. A lot of folks expecting higher tax refunds.
You know, I've been trading Chipotle for a couple of years, and a couple of years since the stock, really since the stock split. Prior to the split, and if I remember correctly, I think it was a 20-for-1 split. Either 20 or 10-to-1, but before they split, it was almost untradeable. But since they've split, and I think it opened around 60, went up to about 66, and now it's been straight down since then, and trading, under 40. Yeah, I do trade it. It is tradable here. It's okay liquidity wise, and I mean, for me, I'm a little different than most, but for me, I'm just a put seller in Chipotle, not for any other reason other than it's cheap relative to where it's been. So on a consumer side, if you're talking Chipotle, yeah, I mean, I hope they keep the red chimichurri, and I hope people continue to sell puts in there.
Tom, that stuff is so good. Now that I will pay an extra $3 for, and I'm okay with that.
Me too, by the way.
Yeah.
Me too. I'll pay anything for that.
Right. If I could just take down and put on a $1 taco off the $1 menu, things would be great. Tom, Brooke, this was the right panel for the right moment in the markets. Thank you so much. I'll talk to you soon. Straight ahead, a reminder from me on why not to lose focus on oil markets, even with software stocks dominating your mind. All of that is next. I know you are totally wrapped up in watching tech stocks right now, but a helpful reminder from yours truly, don't forget about commodities, because the bottom line is this. While it's great to stalk developments from Anthropic, what happens in commodities like oil is vital to the profits and cash flow that corporate America produces every single quarter. This is why I'm putting a spotlight on earnings out of oil giant Phillips 66 today. There were positives and negatives to the report. The positive here is that earnings thumped estimates. The not so positive is there were continued pockets of margin pressure in the business. Phillips 66 Chief Financial Officer Kevin Mitchell is back here on Opening Bid. Kevin, good to see you here on your busy earnings day. So take us through the quarter a little bit. Out here with an earnings beat, what surprised you? Let's start on the upside in the quarter.
Yeah, good morning, Brian. It's great to be here again. Good to see you. So yes, a good quarter both on the operating and financial front. We generated, in fact, third consecutive quarter of strong operating and financial results. We had record performance both in our refining and our midstream business, record NGL throughput, transportation volumes, as well as fractionation volumes. Refining ran at 99% utilization and generated a record clean product yield. So we feel very good with all the work we've put into helping enable us to generate results like that.
A lot of the contacts that I'm able to catch up with, Kevin, that cover your company, they all They give you credit for cutting a lot of expenses, really focused on margins right now. What will get margins higher in your business as the year progresses?
Yeah, so we're pretty optimistic on the overall demand outlook, especially in the refining business. We continue to see strong demand fundamentals. We also are, as you point out, we are a margin business. And so it's both the cost of our feedstocks and the prices for the products we make that really matter. And with what we're seeing in Venezuela and more heavy crude coming to market, we're a large consumer of heavy crude across our system. And so that widening of that heavy crude differential is a benefit to us as well. So that's another margin uplift for us.
Before I get to Venezuela, what is the state of that chemical business? Has that bottomed from a margin perspective yet?
Well, we hope it's a bottom. So we're in a tough spot in chemicals. We're in a somewhat of a cyclical trough. Fortunately, from our standpoint, our chemicals business at CP Chem is focused on the low-cost operations. So Gulf Coast and Middle East presence predominantly, low-cost feedstocks, low-cost ethane supply into those facilities. So even though it's a tough time, they're still profitable. They generated $145 million of EBITDA for our share in the fourth quarter. So even in this time frame, we still feel optimistic over the long term about that business and the long-term supply-demand fundamentals.
For those not really in the trenches on this issue like you all are, Kevin, what does a resumption of Venezuelan crude, what does that mean to the U.S. oil markets? And then what does it mean to oil prices here in the country?
Yeah, so just to be clear, we don't produce oil and gas. We're a consumer of crude oil in our system. And more Venezuelan crude means more crude supply in the overall markets, but specifically more heavy crude supply. And with our significant coking capacity we have across our refining system, we consume a lot of heavy crude. With more of that supply into the market, then that puts some pressure on those heavy crude differentials, which we're able to benefit from. And so that's beneficial to us and those like us that have that refining upgrading capacity.
Do you see, is this the year that supply and demand become better in balance?
Yeah, I think so. I mean, we saw some good supply-demand trends in the second half of 2025. And as we look into 2026, we remain pretty optimistic, barring any major jolts to the global economy. We're pretty optimistic that the demand trends are going in our direction. And in terms of new supply from a refining standpoint, relatively limited.
Back on Venezuela, Kevin, how long, there's been debates on how long it will take to actually get this oil flowing again on a consistent basis. Of course, Chevron is one of the main players in there. But will it take decades?
Well, it's hard for us to answer because we're not directly in that business. I do think it will take time. I don't think there's any immediate uptick in production, and there's a lot of work that has to be done in Venezuela to bring that crude production back. I mean, as you know, they were at 3 million barrels per day or more back in their peak, but that was quite some time ago. And so it is going to take a lot of time and investment to get there. And we, from our standpoint, we are ready to consume that crude or similar crudes through our system.
What is of course, you've seen these comments from Exxon CEO. He called Venezuela, quote, uninvestable. How do you see it?
Well, fortunately, we don't have to make those decisions. Given the nature of where we are, I can understand the challenges going into a country like that where you've already been expropriated in some cases more than once. So clearly there are challenges, but there's also a lot of interest. It's a huge oil resource that's available in that country. And so it's natural there will still be a lot of interest in getting a stake in there.
Getting so many different economic reads, Kevin. I had a good conversation yesterday with PepsiCo's CEO. They're focused on lowering prices to make things more affordable for consumers. But I think about your gas stations that you operate. I mean, what's your read on the U.S. consumer at this point in the economy?
From what we see, the consumer economy has been doing fine. Gasoline demand has held up. Diesel demand has been strong. In fact, we saw some growth in demand for fossil diesel, partly because of some of the challenges on the renewable diesel business. And so our view into the economy through that lens has been quite positive, which is part of what informs our relatively upbeat outlook as we look to the through 2026.
You think gas prices have further to fall?
That becomes a pricing call. Where the crude prices go, what happens on the margin, the refining margin front. So it's a hard one to predict. I mean, we focus on that margin, and there are a lot of dynamics at play. This is a supply-demand balancing on a global basis is what drives this. And so there are factors that we just can't really have control over, and that's the important point. We're focused on those things within our control, which is operations, reliable operations, safe operations, managing our cost structure, and helping get product to market at what's our lowest cost possible.
All right, we will leave it there. Kevin, good to see you again. Have a great rest of the day. I will talk to you soon.
Thank you very much. Goodbye.
All right, I'm burning up this week. That's how on fire I am with the investing content creation to this point. I'm dropping another episode of my Opening Bid Unfiltered podcast tomorrow at 8 a.m. This is a rare interview with the founder of the World Economic Forum, Dr. Klaus Schwab. Going to the annual WEF meeting of top business leaders has changed the arc of my career, so it was good to get some time with the man who created all of it in 1971. We discussed his legacy, the future of humanity, and the influence of President Trump. Talk about some weighty topics in an afternoon. You can watch the episode on Yahoo Finance, YouTube, and all major streaming platforms, or listen in on Spotify, Apple Music, Amazon, and iHeartMedia. Have a fabulous day.